Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. So the U.S. is now going to pause the effort to help stranded ships exit the Strait of Hormuz. Tuesday night in the States, President Trump said he's making this move for a short period to see if an agreement with Iran to end the war can be finalized. Now, crude oil prices are in retreat in the Asian session, as was the case during U.S. trading. And at the same time, we had the U.S. equity market rising to fresh records. And the improved appetite for risk did help to send U.S. Treasury yields lower right across the curve. For a look at some of this price action, I'm joined by Bloomberg strategist David Finnerty. David joins from our studios in Singapore. There's been so much volatility in this market. It's really tough to figure out what's driving the price action. Is it all about crude oil right now, do you think, David?
I think certainly if you're in the FX and rates space, that is the main determinant. We are obviously at the mercy of headlines. As you're seeing today, there's these moves because of the headlines you just mentioned. So we are at the mercy of those. But I think at the end of the day, oil is the still driver. I mean, you look at oil still, it's moved, it's come up slightly, but Brent crude still, let's say, ballpark $108, still very elevated to where it was. Yes, it's not 120 or something, but it's certainly not 70. So, yes, treasuries did come, we saw treasury yields come down yesterday, but they're still elevated again because at the end of the day, we don't know. The glass is always half empty for the markets, certainly for the equity markets. And there's hope, but hope doesn't need reality. I mean, this war was supposed to only last, 3 to 4 weeks, and here we are in the third month. So I think the question is, yes, there's positive signs, but at the end of the day, Hormuz is still blocked. At the end of the day, we still have an oil problem. Until that is resolved, I don't think we'll see anything meaningful moves in the FX rates market, because at the moment you've got, pressure on inflation while oil remains at these levels.
Well, in the equity space, I think we can agree that the chip makers are undoubtedly the star performers here. In the New York session, we had word that Apple is considering using both Intel and Samsung to build the main processors for Apple devices in the U.S. Intel shares jumped 13% in New York trading, and we had the ADRs in Samsung during the London session up by more than 8%. Right now, Samsung in Seoul is up by more than 13%. We had the news from AMD after the bell with a forecast for revenue that was much above the forecast. AMD shares jumped 15% in late trading. It seems like this chip trade is just on fire and it will not stop.
Yes, certainly. I mean, in trading, they say the trend is your friend, and the trend is definitely one way here. And so, yes, it goes high. Now, I think the catch also is at the moment is any market at some point there's some sort of pullback. It's quite standard. But at the moment you don't want to, if you don't get involved in the trade, then you're just missing out on these huge returns, which you said, which are one-day returns. So I think at the moment the sentiment is just, let's just go for it. The upside is, the results are coming in overall very well. So the upside is growing and growing and growing. So I think at the moment, it's just like the sentiment seems to be you have to be on that train. I said at some point, it's a mini, I'm not going to say a correction, but a mini pullback. But then I think a lot of people will say that I've just used that as an opportunity to actually buy again. So I think the trend at the moment is definitely, as you said, for anything AI related or chip stocks related, is certainly, that's where people are happy to put their money.
So let's talk about your specialty, which is rates, foreign exchange. We had the RBA meeting yesterday, and obviously an increase in the policy rate. I think that was the third consecutive move to the upside here. The governor of the RBA, Bullock, was signaling that she would now pause to assess the next step. Give me your sense of what central banks right now are struggling with. If you can put the RBA aside for the moment, that seems to be a bit of an anomaly given some of the other forces at play right now, right?
Yes and no. I mean, yes, RBA hiked, and it's just, I think it was the third consecutive hike. But I think in the press conference, she did allude to the problem that I think all the central banks have, and that's the reason why she signaled a pause, which is, okay, we really have, yes, we know it's inflation pressures, but we do know that there is signs of an impact on growth now as well. Now, not every central bank has a dual mandate, but certainly many of them do. And if you do, you're going, okay, I'm in this problem of, yes, inflation's picking up, and we can see that already. The knock-on effect on growth and employment is showing signs of seeping through, but hasn't fully seeped through. But they are cognizant that those cracks could develop more, shall we say. So I think every central bank, and certainly you mentioned, if you look at the Fed, that was a classic example, they're aware of the two-sided risks here. So I think that's a problem for every central bank now. It's like, okay, look, yes, you've got a lot of inflation, but if I just hike, then you've got a near-term problem in terms of employment and growth. And so where do you find that balancing act? There's always a price to pay, but you don't want to go too far one way or not go far enough. And it's a fine line. And of course, the catch is we don't know how long this will go or how long oil will stay elevated. We just don't know. And of course, the longer it stays elevated, the bigger the impact on both those factors. So that's the big intangible that I think every central bank has.
For the moment, would you say that the Australian dollar then is on firm footing and we could see a lot more in the way of strengthening?
Yeah, I think, well, for the Aussie dollar, I think the trend, Aussie dollar has certainly been a strong performer. I think any weakness in it has been an opportunity to buy. That's been the sentiment towards it. Because of the hiking path that RBA has been on. The growth has been relatively okay. And also what's interesting, it's obviously been a risk barometer. It's normally a risk barometer in terms of, risk on, Aussie rallies, which we've seen today. But even what's interesting, in risk off moments, it sort of didn't sell off as much as you would normally anticipate. So it's sort of detached itself from half of the risk equation. So overall, you go, there's many good reasons to go, if I've got to pick a currency, which I like, which is a strong performer and strong fundamentals with it, the Aussie's certainly one of them that would come to the front of mind.
I'm seeing a little bit of dollar weakness right now. So if we can agree that crude oil is really what we're looking at here in terms of trying to understand what the market feels about the trajectory of the war and maybe some level of stasis or at least pullback in the level of tension, do you necessarily think that the dollar's path right now is to the weak side?
If there is if this trend of good news, we say, keeps coming, certainly if there's a resolution to the war and all force, then yes, I think the sentiment is definitely dollar weakness in the near term. I don't know how many traders I speak to, just an awful lot, and they all pretty much across the board say the market, the hedge funds, everyone is biased towards selling the dollar. Now, having said that, I'm not saying that the dollar will collapse. I think that's another category because at the end of the day, how dovish can the Fed be in this scenario, even with Kevin Walsh taking over? You may get one cut this year, you may get none. The market's looking for none at the moment. And the other factor is US growth is overall performed quite well. So, if you look at the dollar index or the Bloomberg dollar index, the big carries that weight against it is certainly like the euro and the yen. And though the euro has its problems, certainly with elevated oil prices, we know the yen has its problems, and those haven't gone away. You're seeing dollar yen back up towards 157, 158. So I do think, yes, the sentiment would be sell the dollar. There'll be near-term downside. But again, whether that's just a dollar period just tumbled lower, I don't think quite goes to those levels.
So we mentioned the strength that we're seeing in some of the chip makers, particularly SK Hynix, Samsung today, and I'm seeing a bit of strength in the Korean won against the greenback. Do you want to be long the won at this point, given everything that we're talking about as it relates to chips?
Yeah, look, I think the one's an interesting one because you said from the AI sector or the chip sector, the won and Taiwan dollar are obvious sort of plays, if you like that. I think the catch is, again, though, they're both big net oil importers and said oil's still very elevated, so that hasn't solved that problem. I think you get a bigger bang for your buck in terms of, if you like, the won when the oil is taken out of the equation. Until that happens, you're sort of at the mercy. And if you look at the won's behaviour, it's trying to rally, but it's struggling. It's up today, but then a wrong headline comes out and it's weaker again. So I think it's got certainly a lot of upside potential, but you really, for me personally, I'd like the oil side to come out and that have some resolution to that. Oil, 108, I don't think it's good. I certainly would like oil under 100 to see the won really get an extended rally.
All right, David, good stuff. We'll leave it there. Thank you so much. David Finnerty, Bloomberg Strategist, joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. And as I mentioned earlier, the U.S. is pausing its effort to help stranded ships exit the Strait of Hormuz. Tuesday night, President Trump said he is waiting to see whether or not an agreement with Iran can be finalized and signed. Trump also said the U.S. blockade of ships transiting to and from Iranian ports would remain in full force and effect. And that's where we begin our conversation with Kirsten Fontenrose, strategic advisor at Systems Planning and Analysis. Kirsten spoke with Bloomberg TV host Sherry Ahn and Heidi Stroud-Watts.
We're trying to understand what's actually changed in the 10 weeks since the start of the war, because you're telling me that the offensive action from the U.S. is paused at the moment. The naval blockade actually continues. So what's been done so far in terms of any progress on ending this war?
The main instrument you're looking at now, the economic fury, could not have happened without the military operations that preceded it, because if you tried to apply this kind of naval blockade that blocks Iran's trade to squeeze them economically, they would simply have responded with military action on that blockade, on the ships, using air to or ground to air missiles against the helicopters and drones and the like. So you had to have those military operations to take a lot of that arsenal off the battlefield in order to have this blockade now squeeze them economically. So it's a two-prong approach, but you couldn't have had them the other way around, and you couldn't have had one without the other.
President Trump continues to urge allies to help in the Strait of Hormuz. Why should allies help when before this war, the strait was perfectly open and the U.S. did not necessarily consult any of the other partners around the world?
3 reasons. First, Iran has the opportunity to close the Strait of Hormuz at any point. So the fact that they did this now is not unique. They could have chosen to do this after, let's say, there was a scenario when Russia was successful in Ukraine and it decided to roll over Europe. It could then have closed the strait, and Europe would have been in a much more difficult position. So this is a lesson for Europe, which is why the U.S. is asking for that support. 2, the U.S. does not rely on the strait. You've heard this a million times, as much as Europe and some nations in Asia do for their trade, for their energy. So it's the U.S. now addressing a problem set that is theirs. And 3, the U.S. laughs a little bit, honestly, when Europe makes the argument that they didn't ask for this war because we think about World War I and II, where we were not consulted and we did not support going to war, and yet we did. And in both cases, we came to Europe's defense and frankly saved them. So the question here is, will Europe sort of return that favor when it's in their economic interest more than anyone else's?
We are headed towards the President Trump and President Xi Jinping summit. Is President Trump going into that meeting in a weakened state, given that there's no resolution so far to the war?
Not a weakened state, because remember, one of the things we're expecting to be discussed at this summit by both parties, though they won't put it on the table beforehand, is whether or not China will now start buying oil and energy from the U.S. It's going to be one of the largest producers. It might be a bit more expensive, but if Iran's oil is either off the market or going to non-Chinese markets, and if the Gulf is at risk, then China may wish to extend this as a goodwill gesture to the U.S., and the U.S. may wish to keep this as an offer to China. Look, you're suffering economically without it, but we will allow you to buy our oil. It could be a win-win, but I think you'll watch both sides maybe save it as their own little trump card in those deals, and both will present this as something that's good for their own people. But it would wind up being a boon for both.
It's interesting. Trump says that President Xi has been respectful when it comes to Iran. He's sort of downplayed reports of sort of strains and obviously a disagreement on how this war has played out and the way that the ceasefire negotiations have gone. How do you, I guess, rate the relationship at the moment? Because clearly so much of that focus has shifted away from the bilateral competition between China and the US while this war has been ongoing.
I think both China and the U.S. are hoping for a trade deal to come out of this summit. And so they don't want this Iran conflict to do more than strengthen their own position in it. And they're both posturing to make sure that it can. We do know that China is using this laboratory. They're watching the way U.S. military operations pan out. They're watching the way equipment performs. They're providing Iran, we believe, with some, either whether it's technology or insight, imagery, the way that Russia has. So they are definitely using this to size up the U.S. military machine. And the U.S. is using this as well to show China, how quickly this kind of military operation can be spun up, and how much power the U.S. can bring to bear to a war that is predominantly focused on naval operations at this point. So both of them are using this war in a way that they hope will strengthen their position, both in their own negotiations and in any future confrontation between the two of them.
This is a $25 billion war so far. This is by the Pentagon's own estimates, right? And there's a lot of questions over those numbers, not to mention, in addition, how much further spending will need to be incurred by things like repairing damaged U.S. military bases. Do you think this has put the sort of defense industrial base when it comes to the U.S. on a weaker footing, particularly as we go into this meeting between the Chinese and U.S. leaders?
It's dual-sided, because yes, it means that the U.S. Industrial base is a little bit depleted, but it also sparks innovation, and it's really sparking that kind of the government spending that you mentioned that will then spin up production of new iterations of these kinds of weapons and defenses. So a lot of them that are being expended now will be replaced with newer models. It's also giving the U.S. military a lot of practice. So China would come into a confrontation with almost no practical battlefield practice, and the U.S. is having that with their own equipment, with potential partners' equipment. They're looking at integration. They're looking at new domains like space, and cyber's not new, but the integration of all these domains is something China has never practiced in real world. So while the industrial base is going to have to play some catch up, there are still benefits to it, to what is taking place.
That is Kirsten Fontenrose, strategic advisor at Systems Planning and Analysis, speaking with Bloomberg TV host Sherry On and Heidi Stroud-Watts, bringing you their conversation here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.